Hey everyone, this is Michael, and this is the Market Trend Advisory Weekend Report for March 19, 2022. Well, before we start, I just wanted to do my usual disclaimer that the content and information in this presentation is provided for educational informational purposes only, and in no way should be considered investment advice. So let's go ahead and get right into the trend. We had a huge change this week. Last week we were in a pretty steep correction and in a bear market in the NASDAQ. And within a few days, following a follow-through day we had, market just flew upwards with 4 very strong days in a row. So we are back in a confirmed uptrend, and you can see there our uptrend resumes. We are now back to adding exposure to the market. Individual stocks and non-index ETFs, we've changed our signal from no positions to up to 25% exposure because we're starting to see individual stocks improve the way that they're acting. They're not all just failing and just rallying and then failing in the rally, the base is breaking, all the things that we've been seeing for quite a long time. For the NASDAQ, our market count on Friday, yesterday, we had 2 more market count buy signals. So we're up to 3 out of 5 and with a 75% exposure. And we have no institutional selling days, and the power trend is off. The S&P hasn't been as strong, but has been also very, very strong. And so we're back to add exposure for our index action signal, and we have up to 20% exposure in the S&P, just because it's a little stronger technically, but the NASDAQ has been really where the action's been the last 3 or 4 days. So it's got a market count of 2 out of 5, and the market exposure is 55%. And no institutional selling days, power trend is off. So that's been a big change. So let's take a look at what's been going on. We'll start with the S&P, because the S&P on this day here had its day 15 follow-through day. And what that is, that's a day where the market closes up at least 1.25% on higher volume than the previous day. And these follow-through days have an amazing history over the last 100 years of catching market bottoms. That doesn't mean we always just zoom up and that's it, we're in a new bull market. But no uptrends ever started without the follow-through day, but it doesn't mean that the follow-through days always succeed. So we've had a few back here where we had follow-through days and then ultimately we failed. We would cut below. And but you can see here, we had 4 days in a row. We opened at the lows, closed to the high, open lows, close to the high. This is super powerful market action. And you can see we actually closed right at the 200-day moving average, which is this black line here. And we even got above the 50-day on the S&P. So this has been super powerful. We expect to get some resistance around here. So, and we'll talk about in a second what's kind of going on in this huge rally. Let's take a look now at the NASDAQ. This is also just this. The NASDAQ rose 8.5% in the week. It's almost gotten back half of its bear market, 20% move in 1 week. And actually, these 4 days is the largest weekly point gain on record. That's in history. That is just unheard of. And part of this came is because and the volume was massive too. In fact, let me go back to the S&P. You can see this huge volume here, but that's actually because we had quadruple witching, which is the expiration of stock features, index options, and stock options. So that's what causes sometimes these days with just massive volume coming in. Now the NASDAQ closed right at its 50-day, and it's declining 50-day. That's the red line. So again, we expect some resistance here. And one thing I just wanted to say, because people always seem to want to short. They want to short the market, and the market starts heading down, or they're shorting it when it's going up. So let's say for example this rally here. People are going, no, I'm going to short it, and they short it, and they short it, and they're just losing and losing and losing. The time to actually short a market is not when it's making new lows, but actually when it rallies back up to the 50-day or another element and then fail from that point. So if you look at here, you can actually see this is a little bit of one of the best patterns is head and shoulders, which we don't really have here. I mean, you could argue this is the shoulder. We made a little head here, but this is a little too extended. This would be the other shoulder. In a more classic pattern, it would be closer over here. But here we actually rallied even above the 50 days. So it's not really this kind of pattern, but Normally this would rally up back to the 50-day and then fail. Here we just kind of stopped at the 50-day and then plunged, and that was really, if you were going to short this market, it was right here, but it didn't give you a clear signal. Now, I've got this little note here. This is why shorting is so difficult, is because a lot of times people, when the market's already falling, is when they start shorting. So they start shorting here. Oh yeah, look, it's breaking to new lows. Okay. And then just a day or two later, you get these massive rallies that scares everyone out. And in fact, that's really what's gone on these last 4 days. It's just looking at in more detail what's been going on, we just have huge bottom fishing going on and huge short covering. It's caused a lot of this run here. So this is why it's very difficult to short. We even did it in our case study. We tried shorting the market in corrections. And in our last case study, this wasn't really published because we didn't keep this in there, but I think after the 8.5 years, we ended up with 0.1% gain in 8.5 years, because all the gains got wiped out during these kind of rallies where we're actually still short the market. But then by the time we actually bought it back, we had just lost all this gain. And if we were using leveraged ETFs, this could be a 20% gain just got just disappeared, or you had a 20% loss depending on the thing. So it's just very difficult to short. So that's a great reason why you can make it. Well, it's probably to avoid it. It's much easier to make money on the long side than on the short side. So I want to show a couple other things here too. Again, we were talking about how these are these short covering moves, and I want to give you a little chart here that of the biggest one-day moves in the Dow. And if you look here, we had some pretty gigantic moves: 15%, 14%, 10%, down to 7.5%. But if you look closely, most of these came in the middle of huge bear markets. There's a lot from here from 1931, 1929, the middle of the Depression, the huge bear market. There's other ones from, here's the 87 crash. We had 2008, where we went down, didn't bottom until March of 2009. So it's commonplace to see these huge moves in bear markets. Now, whether or not we are still in a bear market, a bigger bear market, and this is just a very strong rally out of it, we don't really know. But but seeing these massive moves, inside of coming off a bottom, is a characteristic of a bear market. So we're going to kind of keep that in mind, and we'll be talking about in a second about sort of how to approach this. Just quickly with our investing strategies, we did on the NASDAQ have 2 buy signals that happened on Friday. So on Monday morning, we'll be actually adding up to our exposure from 30% up to 75% in the QLD and the TQQQ. We have a little improvement in our stats just because we're 30% exposure. We took advantage of those big move. The S&P, we're at no change because it didn't add any new buys, any market count buy signals. So we're still at 55%, and there's no action on Monday morning. And I've actually changed this. It used to say next, it said something else, but sometimes, like when it's a Friday, it made it a little confusing, so I just made it for the next trading days open. So, and you'll see this again on the big master database, and this now appears on the daily emails and also on our summary that appears on our Market Trend Advisory member page. So just to wrap it up, I'd say really we're in a new uptrend, but we're going to exercise caution. As usual, we don't pile into the stock market ever. We let the market pull us in. And that's what our system does. We've crept from 30%, and it looks like we're going to 75 pretty quickly. We're going to watch that carefully because that may be a lot, and it wouldn't be uncommon for the market to take a few steps back after 4 very powerful days. But we're going to just keep all that in mind. Now, again, we've been seeing a lot of beaten down stocks just come flying back. I mean, just one example. PayPal rallied 23% for the week, though it's still down more than 60%. So you can see it didn't even really make a dent in its chart on its downtrend, but there are a lot of stocks that did this. In the Chinese market, there are 50% gains in some stocks. In fact, I think the Crane Chinese ETF went up 50%. That's the ETF. Just crazy volatility. And when markets are this volatile, it's really best to exercise caution and not jump in, even if we have other signals, because it's very easy just to get in at the wrong time and take large losses. So we're going to creep in on that. One thing I do want to say is individual stocks are starting to act a little better. So in our stock pick service, we've kind of crept in a couple stocks. We did lose one on Friday, so it's not all green lights. We're still in the red zone, but we might be changing that to at least yellow in the next few days. We'll see how things go. So as I mentioned, not the time to plow full bore into the market. The short covering and bottom fishing were a large part of the week's huge run. Just a few final things. You know, the Russia-Ukraine war, the interest rate hikes, inflation, and a lot of other issues didn't seem like they mattered to Wall Street at all last week, but none of it's changed. All those things are out there, and if anything, this might just be a relief rally. But you know, the market can do anything, and so, anyways, for last week, they didn't matter at all until they once again do matter, which may come back into this week. So overall, the risks remain very high, and the potential for a lot of choppy trading throughout the rest of this first half of the year is probably likely. I don't think we're going to see just continue ripping higher and higher like that. Maybe if we start getting news that Russia backs out, the Fed says that we're not going to raise interest rates ever again, or some stuff that's probably not going to happen. That'd be the only. So I do expect it will be a choppy year, maybe just a choppy to down year, but we'll see. Markets can do anything, and they'll surprise you doing the opposite of what you think is going to happen. And just finally, as I mentioned a few times already today, that these big moves in the indexes come almost exclusively in bear markets, especially when they come day after day. So on really no news. So it's not really a true sign of strength in the market, but more of a kind of a relief rally. Some people call it a dead cat bounce, or just short covering, things like that. So, well, that's where we are. Big changes. You never know what to expect in the markets. But we're back in with the system. We'll ride the market in the uptrend until it peters out or whatever happens. And we'll be back next week with another update. And again, as usual, any questions, feel free to email me. Okay, thank you.